Investing for impact, how to align your portfolio with your values. We're going to cover an introduction to sustainable, responsible impact investing, types of SRI portfolios, SRI strategies, investment options, portfolio construction, and some examples and some next steps. We have a free SRI ebook, a practical guide. You can find it at aiofinancial.com/resources. I'm Bill Holiday. I'm a certified financial planner. I'm accredited investment fiduciary and a chartered SRI consultant. I was in the Peace Corps and got exposed to microcredit. That's really where I first had an interest in using capital to help others. And I've been working as an advisor, focusing on SRI since 2004. Okay, let's start with an intro. SRI is an investment strategy seeking to maximize financial return and social good. There's a lot of names for it: sustainable, responsible impact investing, or socially responsible investing, ESG, which is environmental social governance investing, sustainable investing, double bottom line. There's a few names. They're all referring to making an impact with your investments. So a lot of individuals would like to invest or are interested in sustainable investing, but a majority don't feel like they understand sustainable investing enough to invest or to participate. Hopefully, we can solve some of that. Why do people engage? One, it's a political tool. It's another way to influence society outside of the government. Companies influence the government through lobbyists, through campaign contributions. You can influence the companies. And if you can influence the companies where the money is at, you can make lots of changes. If you're trying to reduce carbon emissions or climate change, addressing companies is a way to approach that issue or many issues. You influence the companies directly instead of just trying to hope government will control the companies. People engage with SRI because they have a specific issue they're interested in, and it could be labor practices, it could be climate change, could be political contributions, executive compensation, could be a number of things. And then beliefs could be a reason that's driving people's or someone's participation in SRI. SRI has exploded over the last, 10 years, 20 years. It's a totally different investment world than it was when I first got involved with it 20 years ago, which is great. It's just exploded. They're saying about 18% of all managed investments have some kind of environmental, social governance screening. It's grown just an enormous amount. And we've seen a lot of growth in the US. You could see over this 6-year period, some international, Europe, Australia, not as much of a change, but boy, in the US, it has become a big part of our investing. Why has it grown? There's a lot more availability. There are a lot of funds out there now. There's better performance, lower expenses. I think there's also more information, more awareness that this is an option. There's more, desire to make an impact. There's just more information out there about issues and companies where people don't want them in their portfolio or want to influence those companies. So another reason people participate is if you're just in a normal index, these are a lot of the holdings that you'll have in your portfolio. And you may want to either exclude these companies because you don't want these companies in your portfolio or don't believe they have a good future, or you may want to influence these companies. So funds have a few ways to approach things. One is to screen, and another is to engage with companies. And some funds do both. But there is, I guess there are a lot of companies that could be influenced. If you just hold a general index that's not voting on shareholder resolutions, you're just voting with management, just holding up these companies doing whatever they want to do. Types of portfolios. So there's not just one standard SRI portfolio for everyone. There are different focuses, there are different ways to approach it. We have some clients that just want SRI in part of their portfolio, and maybe it's for large US stocks. They'd like them to either be responsible or they'd like to engage with them. Maybe they want some community investing, and that can include a community investment fund in their portfolio, or just banking with a local credit union. Just doing something a little different can be their engagement. You can have an all inclusive SRI portfolio. There are enough types of funds where you can get emerging markets, developed foreign, small cap US, large. You can get a full diversified, even bond funds, diversified portfolio with all SRI that's available. Or there could be a specific issue. You just don't want fossil fuel companies in your portfolio. That can easily be attained, and that could drive that type of a portfolio. Performance is a big issue or pushback we hear, that people are concerned because they're scared of performance of SRI funds. The last few years, looking at SRI or holding SRI has not hurt your portfolio. If we look at funds, this is just an example of the last, 3 years. You can see the COVID dip there. The blue line is the S&P 500, just the index. And the red is an SRI fund that is using environmental, social, governance information to include and exclude companies. And you can see, I mean, one of the biggest differences is going to be fossil fuel companies make up about 11% of the S&P 500. And so if fossil fuel companies are outperforming the market, then you're going to see underperformance on the SRI funds. And in 2022, fossil fuel companies did great and they closed that gap you can see in this graph. In 2023, fossil fuel companies, and in 2021, fossil fuel companies underperformed, and you can see the SRI fund, in this case, do better. There have been studies of studies. This is a case of 1,800 studies showing the relationship of including these environmental, social, governance criteria in investment decisions. And about 90% of these studies are showing that there's no negative relationship between ESG performance. So if you look at, they're saying about 48% showed that including ESG criteria improved performance. 23% it was neutral. And then there were mixed results, and about 10.7% said it was negative. But the vast majority, about 90%, are saying there isn't a negative correlation or negative relationship between using environmental, social, governance criteria in your selection. So, some strategies. There are 3 strategies to SRI: screening, shareholder advocacy, and community investing. So, screening is including and excluding companies based on their ESG record history. You can exclude or include industries, like you can exclude all oil from your portfolio, or you can pick the best of the worst. Maybe you'll include natural gas but exclude oil, or you can avoid that altogether and just include alternative energy. So there's different approaches. You can avoid certain countries. You can look at corporate social responsibility, how their record is, if you want to include them or exclude them, or engage with them. You can include a company with the idea of making changes. Their policies and practices, you can make that as a criteria for including or excluding. Or more likely, that could be the funds criteria that you want to invest in. Shareholder advocacy. As a shareholder, you're an owner, you have a right to vote. You can vote on shareholder resolutions. You can engage with companies. Of course, you can meet with companies, or you could divest and just not be in there at all. If you do not vote, management votes for you. So a lot of shareholder resolutions pass with 30% participation, or with a less than majority vote for sure. There are a lot of funds that are not voting, especially on environmental social governance issues. If you're in a non SRI fund, whether it's a mutual fund or exchange traded fund, they're most times not voting on environmental social governance issues. They don't want to get into these issues. So if you pick a fund that is in line with your values, that their goals are in line with your values, they'll do that on your behalf. You don't have to be calling companies. They will engage with companies on your behalf. Now, some funds will engage heavily. They have dedicated staff. It's part of their mission. They are deep advocates. Some funds will just vote proxies. They don't have dedicated staff to this. We call them base advocacy, and they're doing some engagement, maybe more screening than engaging. And some, of course, a lot of investments don't deal with environmental social governance issues at all. Um, Types of holdings to participate. So, of course, you can get in individual stocks. You can engage yourself, writing letters. You can write a shareholder resolution. There's criteria to it. It's nice to have a lot of support financially. And then there are SRI funds, mutual funds, and exchange traded funds. They'll participate on your behalf. Okay, some of the leading ESG resolutions are around corporate political activity, labor, employment practices, opportunities, climate change, of course, executive compensation, independent board of directors or board chair in this case, human rights, board diversity. There's a lot of issues that can be addressed as owners through shareholder engagement. The leading criteria, we have environmental, social, governance, specifically climate change, anti-corruption, board issues, sustainable agriculture, executive pay, um, products is an issue, military weapons, yeah, green building. There's quite a few areas depending on the company, of course. All right, the third component. So we have screening, shareholder advocacy, and community investing. And community investing is providing capital to communities. It could be people or organizations that otherwise don't have access, or don't have access to low interest or reasonable interest capital. Ways to get involved, or structures. There's community development banks, credit unions, there are loan funds, there's venture capital funds, micro enterprise funds, loan funds. I think another thing just to mention in this community, I think we're going to talk about this in a upcoming slide. So investment options. Here's a look at some funds that are out there, and these are all ESG funds. You got your minimal engagement funds, these top four. They're doing base, very little engagement. Um, Probably not voting, but they are doing some screening. So they're ESG, and maybe that could be good enough. Some funds are fossil fuel free, and maybe that's all you want. You don't care about engagement. You just think fossil fuel is a poor investment decision, and you'd like a portfolio without it. Great, great. There's base engagement where they are doing some engagement. So they are voting proxies. They might not have dedicated staff and might do more screening than engaging, but they're doing some engagement. And you can look at the expense ratios. The minimal engagement are going to have in general, are going to have very low, um, well, are going to have lower expenses. There is an expense to engaging. If you have dedicated staff, there's a cost to that. Sometimes they don't have the size of some of the bigger indexes, so there's going to be more cost. If you look at deep engagement, engine number one's kind of a standout with its low expense ratio of 0.05. They don't do any screening. They hold the S&P and they are engaging with anyone they can. So they're engaging with, they've made it a mission. Environment is their big issue, but they're engaging with agriculture, transportation, and energy. They feel like you have to make a push in those areas, even if it's companies you might not agree with, but you have to push them instead of screening and only engaging with responsible companies. So deep engagement, generally they have dedicated staff to engaging with companies. For the community investors, so these are some funds. You can screen funds, um, exchange trade funds or mutual funds based on how much engagement you want. Of course, performance, what area, if you're just looking at large US, or if you want diversified portfolio, you're looking for certain asset classes, or bonds, bond funds. You're looking for those asset classes, you're looking at expenses and performance, and then you want whatever level of engagement you'd like to look at. On the community investment side, you can get some exposure through funds. There are some SRI funds that will have a percentage of their portfolio in community investing. It may be 1, 2%. It may be a larger percent, depending on the fund. So there are community investment notes that you can hold right in a brokerage account. Right at a Schwab or a different brokerage account, you can hold a community investment note. It works kind of like a CD or a bond. You put in your investment, there's a maturity date, they're paying an interest along the way. There are a community development financial institution. There's a directory of credit unions and banks, but you can get a CDFI, or even just banking with a local credit union. A lot of times their money is staying local. So it's not going to some global bank that's investing in whatever coal plant or whatever large project. It's local, smaller projects for people in the community. And then there are some that are focusing on certain populations, and then they get that CDFI designation. There are alternative investments directly with a microcredit organization or different um, loan funds that you can invest in directly. Portfolio construction. When you're developing your portfolio, you want to look at your time horizon, how much do you want in stocks and bonds, your risk tolerance. So with our clients interested in SRI, we look at their retirement plan, their spending plan. You look at it normal, like you would for anyone. Just how much do you want in fixed? How much do you need in cash type investments? And then when you're picking the specific investment, that's where you're looking at the SRI component. But you're looking at time horizon, risk tolerance. Normally, we have an SRI questionnaire, and it's in our ebook. Questionnaire, so you can get an idea of the values of what your priorities are, so that you can pick funds that are in line with those priorities. So, how we look at that, how we evaluate companies and funds and portfolios, is through a tool called Your Stake. And so they can look at a portfolio and tell you how it's balanced in energy or in the environment or health or in different categories. Equal opportunity. Do you have exposure to migrant camp companies that work in private prisons, or there's a lot of areas you can get details about how your group of funds is exposed. They also look at the engagement. So, is there shareholder advocacy in your portfolio for certain issues in certain areas? So, this is a portfolio level evaluation that we use this tool for. It also works on a fund evaluation level. You can look at different issues and how they rank. And again, maybe a fund like engine number one isn't even screening. They're not trying to do well in these different areas. They just want to engage with companies and hold everything. Other funds are doing screening, and some are deep engagement. So they are engaging. So this is where we look at base engagement, deep engagement, or minimum engagement, minimal engagement, if you're just looking for screening, and how we pick funds. And you can look at the expense and returns and different components. Again, this is the tool we use. There are other tools out there. And some are, this is meant for advisors, but there are tools meant out there for the public as well. Generally, they're not going to have as much, but they don't cost as much, so that it would make more sense for an individual. And even organizations like USIF, you can look at their mutual fund ETF, read their description and evaluation there. So it gives you some level of screening. You can also look at a company level. So if there's issues that are of concern, or depending on what the issues of concern are, they will rank and give you information about individual companies. And so you could see if that can be an issue. When you're looking at your overall portfolio with this program, they will allow you to dig down and say, all right, this area might be an issue. Let me click on that and see what funds are problematic around that issue. And then within those funds, what companies are problematic. And then you can decide, is it an issue with, it's a private prison that's in your portfolio, or some kind of funds that you want to exclude, or you want to make changes to, or you want to address? Or is it some software or product supplies that are being used for other things, but it's also being used for this issue? And then you can decide, when you dig deeper, or with your advisor, with, it's not that you need to have the information, but then you can make that decision, though, that is that company something that you want to address? Either make sure the fund is engaging with it, or exclude it from your portfolio. So you could dig down to the company level. All right, this isn't a webinar, so we're not going to do questions and answers. Just final thoughts here. There's many options out there. There isn't one type of portfolio. You can fit what your needs are. There's no need to sacrifice returns. That shouldn't be a scary point for people at this point. There's enough data to show that that's not an issue. And you can make an impact through screening, shareholder advocacy, and community investments. That's it. We have an ebook. We're available for questions and consulting. I mean, we're advisors. So if you have any questions, reach out. AIOfinancial.com. We have blogs and social media about this topic. So you could get some more information, but feel free to reach out. I'd be glad to meet with anyone if you have questions. All right. Thanks for spending the time. Bye.